Hello and welcome to tradingfloor.com's weekly Asian focus. In this report with Andrew Robinson, market analyst for Saxo Capital Markets in Singapore, he focuses on Australia, following a series of recent domestic data which has indicated that the slowing global growth tendency is starting to hurt this otherwise fairly resilient nation. Welcome, Andrew.
Hello again.
Second quarter Australian GDP data came in slightly below forecasts, though there's still a fairly solid base for growth down under. The heavyweight, though, in the Australian economy, the mining sector, is feeling some downward pressure, and one particular export commodity, iron ore, is hurting most. It plummeted of late. In light of this, what is the likelihood of the Reserve Bank of Australia meeting its forecast of 3.75% growth already this year?
Well, as you said, the second quarter was actually quite a solid performance. We still saw quite a good contribution from household spending, which was quite a surprise when you consider that the rest of the economy, apart from the mining sector, is really struggling. This mining sector did play quite a strong part in the strong performance of the growth in the second quarter. But I do, as you mentioned, it is facing quite a few headwinds at the moment. First of all, the threat of a China slowdown and the impact this has on the mining and resource sector. It suggests that going into Q3 and perhaps for the whole of the second half of the year, it might be a struggle to maintain this kind of growth pace. In order to reach the 3.75%, we need to maintain growth roughly around about these levels, and I think that is getting to be a bit of a tough call in the second half of this year.
At its policy meeting this week, the Reserve Bank of Australia kept the benchmark rate unchanged at 3.5% for the third straight month, amid the backdrop of slowdown emerging and with inflation basically under control. Is a rate cut then on the cards, and if so, when are we likely to see it?
Yes, the interest rate markets at the moment are currently pricing in 100 basis points worth of cuts over the next 12 months. The most immediate threat is the meeting on October the 2nd, and the chances of a 25 basis point cut are as high as 50%, according to the latest market numbers. So I think, yes, I think that the chances of a cut are certainly more likely this month than they were in September, than at the beginning of this month. So I think overall, yes, we can expect a rate cut, and I do think that there's every chance of a 25 basis point cut in October.
The latest Australian employment report released today showed that 8,800 jobs were lost to the economy in August. Was the data as bad as the headline perhaps suggested?
Well, it looked a pretty bad headline on the base of it, and we did see a knee-jerk reaction in the Aussie 10 to 15 points lower. But when you drill down into the numbers, all the losses were actually in the part-time category, and just a few jobs added in the full-time. So that took a little bit of the sting out of the negativity of the headline. The employment numbers, or the unemployment rate, improved to 5.1%, which was seen as a positive, but that can be quite easily explained away by a fall in the participation rate to 65% from 65.2%, and that's at the lowest it's been since October 2007. So both the numbers were, headlines looked both positive and negative, but once you drill down to them, the actual opposite was true. So I think on balance, I would say it's more or less a flat number with an erring on the slight side of positivity, and we've seen a small reaction in the Aussie, just a little bit higher in the aftermath of the data.
And just on the topic of the Aussie dollar, it has been under some pressure of late, and are perhaps pure fundamentals finally catching up with this otherwise strong commodity-driven currency? And against which currency is it struggling the most? Are we talking about the yen or US dollar or...?
Well, certainly the performance over the last month has been pretty poor. As you say, few of the props that we've had supporting the Aussie over the past 18 months, 2 years, are slowly but surely being eroded away. The mining and resource sector, as we mentioned before, not forgetting the lower interest rate yield that it has, with prospect of further rates to come in the future. And overall, generally, an economic slowdown across the globe. It's not been performing well, even though know equity markets are having a risk-on sentiment to them at the moment, and so it's looking quite poor. There's just nothing positive to be seen in the Aussie at the moment, I think. And if we look at the performance over the last month, we've seen it fall 4.2% against the US dollar, 4.6% against the yen, and a massive 6.7% against the euro. As we know, the euro has gone through a bit of a recovery of late as we anticipate what the ECB might be planning for the EU debt situation. So that's particularly the most currency that has fallen against the most.
Thanks for your insight this week into the Australian economy and the Aussie dollar.
You're welcome.
Take a look at tradingfloor.com for more of Andrew's reports on the Asian region.